Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined the Equity Mates community for the very first time, a huge welcome. My name is Bryce, and as always, I am joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. How could I not be? There is so much happening in the Australian economy, in markets, and in the Equity Mates world, and we're going to unpack all of it in the next 30 minutes.
That's it.
Before we do, a piece of housekeeping. If you enjoyed the Basis Points episodes that went out on Equity Mates, make sure you head over to the Basis Points feed and subscribe over there, because we've continued releasing episodes, but we're no longer going to be releasing them on the Equity Mates feed as well. So head over, Basis Points, wherever you're watching or listening to this, and enjoy it, hopefully. Well, hopefully you enjoy it. But also, if you're a financial advisor, make sure you claim the CPD points attached to the episodes.
That's it. Back to regular programming here on Equity Mates. In fact, tomorrow is Chris Joy.
Yes.
Huge episode.
Spicy opinions from Chris Joy coming in hot.
So make sure you stick around for that. But today we are going to be covering off everything that's happening in markets. We've got a Pimp My Portfolio with Adam Dawes and a community member, and we are going to be talking about the importance of reinvesting dividends and the huge difference that can make to the value of your portfolio. But Ren, let's get stuck into it.
News and markets.
All right, well, three big news stories to kick us off today. We want to cover off some Australian economic news and some fallout, some more news coming out from the budget. We want to speak about the race for self-driving cars, because there are two companies that are going head to head. And we're going to talk about Alphabet's latest deal and what we can learn. But Bryce, let's start with Australia's economic news.
Well, good news, Ren. Good news for the Australian economy, because inflation has cooled to 2.4% in the 12 months to February. Trimmed mean inflation, which is the RBA's preferred measure for underlying inflation, fell to 2.7%, which was down from 2.8% in January. So that puts underlying inflation at its equal lowest level in 3 years.
Yeah, good news on inflation. Yeah. It's funny how one economic crisis passes, the inflation and interest rate crisis seems to move on, and we move straight into the next thing, which is trade war and tariffs.
Yes.
And that might have an inflationary effect, but it is good news, which is a long time coming, I guess.
A long time coming. It's within the range that the RBA try and get 2 to 3%. I wouldn't be expecting any more interest rate cuts.
No, I think the RBA have been very clear about that, and especially with potential increase in trade barriers and what that might mean for inflation. Don't expect any more rate cuts.
No.
But one thing we can expect, because the government are rushing it through Parliament, trying to get it into legislation before the election, is their $17 billion tax cut. Their, shall we call it, the election sweetener?
Yeah. Election sweetener, but just the way that it has been spoken about in media, I feel like it hasn't been worth the squeeze.
No. Well, let me ask you this question, Bryce. When it's fully rolled out, what are you going to do with your extra $5 a week?
Exactly.
Yeah.
$5 a week. I think it's
maybe $10 a week
in
when
2020.
fully rolled out.
Yeah, fully rolled out. And that's the story. That's the headline around it. It's like, rather than like, great, we're getting tax cut, it's like a big deal. It's 70 cents a day.
Yeah. 70 cents a day. No, $10 a week.
No, well, I think the first rollout is $5 a week, and that's what the media is going with at the moment. 70 cents a day.
Yeah.
It's like,
but 70 cents a day invested over 40 years at 11% compounding. Look, I mean, it's just like both sides. Where's the big ideas? I mean, I went on my gas and nuclear rant last episode, so I won't do that again. But I think we recognise we're in a structural deficit. We need bigger ideas than window dressing
Yes.
on the edges.
Yeah.
Pre-election sweetener to try and win some votes. It's like, where is the bold reform that will drive Australia's economy?
Yes.
And that is the extent of my rant today.
Yes. That's fair. That's fair.
Speaking of bold reform, one thing that is coming down the pike very quickly is self-driving cars and robo-taxis. And there's been news from 2 companies that's worth talking about here.
That's it. Waymo's expansion continues. Now, Waymo is Google's self-driving car company. They're hitting the streets of Washington, D.C. in 2026, marking the 5th city that it is going to launch in. They've hit Phoenix, they've hit San Francisco, they've hit Los Angeles, and they've hit Austin. It's a self-driving car ride hailing service that is already punching out 200,000 paid trips per week.
Yeah.
How incredible is that?
So if you're traveling to the States, or if you're listening or watching from the States in one of those cities, you can download the Waymo One app and order a robo-taxi.
Yeah.
The future is here.
Yeah.
It's just not evenly distributed.
That's very true. That's very true.
But not to be outdone, Tesla is also working towards its robo-taxi fleet, long promised. The electric car company has announced Austin will be its first city, and June 2025 is when it will launch its rival robo-taxi service.
Yeah. It's kind of, I find this exciting, but also a little bit of a tease, because we're so far away from getting it here in Australia.
Yeah, definitely.
Yeah, it's just like, God, we have to travel to the States to experience it. But look, the future is here.
The pace will
course,
accelerate.
Of course.
Yeah. This is going to be like, there's going to be huge value creation here.
Yeah, absolutely.
And it will be really interesting to see where the value goes. Like, does Uber and Lyft, do they fall, or do they somehow manage to get into this?
Yeah.
Google is obviously the owner of Waymo. Well, Alphabet is the owner of Waymo, so that's one way you can invest in it. Or if you believe in the Tesla story, you can invest in Tesla. We were speaking about it before we recorded. Simon in our office thinks Tesla is going to beat Waymo. So, Bryce, let me ask you the same question. Waymo and Tesla, if you had to pick one at the moment, one horse to back, one car to back, which would you be backing?
I'm not touching anything that Elon's involved with the 10-foot pole at the moment.
Okay.
I read an article yesterday that goes into each of the companies that he owns, and this was actually triggered by a comment he made recently that he's now admitting that his involvement in Doge is impacting his ability to operate his other companies.
Yeah, well, what gave it away? The Molotov cocktails being thrown into Tesla dealers? Yeah.
But it's come out, and they've somehow done a roundup of all of the companies and got a sense of how much time he's actually dedicating to each.
Okay.
And also then the internal workings of each. And most of them are an on fire, absolute shit show. And I think I was saying to you beforehand,
I think on fire is not the right.
True.
Yeah.
But like, I think for me, and I was saying to you before the show, like it's come out that Neuralink, where he's trying to put chips in people's brains, he's rolling into the office twice a quarter. And it's just like, you can't run a company. And apparently the internal workings there are just chaotic.
You see, because it's interesting. My first reaction when you said he's coming in twice a quarter was, the Neuralink staff probably love that.
No.
Because like the one thing that you've got to give Elon credit for is that like he's built great teams and then empowered them to do really impossible things.
Yes.
Tesla, SpaceX, Neuralink. There can be no denying like the quality of the people in those organizations.
Yes.
And maybe getting Elon out of the way would be good, but it doesn't sound like that's been the case here.
Not at all.
Okay.
But anyway, if back to this question, I kind of want to back I reckon, is the underdog Waymo in this situation? Like, it's hard to get a sense of who is the underdog here. But
the underdog would be like GM Cruise, but they shuttered last year.
They're underground. Yeah. I kind of like Waymo.
Yeah. I think,
and I'm a shareholder of Alphabet.
Same. So, look, this will be one to watch. It'll obviously be a while before it comes to Australia, but don't be surprised if you hear Equity Mates are doing a business trip to America to give it a try at some point. One final story we wanted to cover off, touching on Alphabet again, is their acquisition of cloud security startup Wiz for $32 billion in an all-cash deal. Wiz is going to now become part of Google Cloud's offering. Pretty amazing story from the Wiz founders. So they launched 5 years ago.
Yeah, it's nuts.
It's amazing how quickly you can create value if you know how to code these days.
Value, I mean, it's a $500 million revenue company in 5 years. It's nuts.
And Google approached to buy them a bit over a year ago for $23 billion.
Yeah.
And they said no.
Yeah.
And they made Google up the price. So a pretty amazing startup story. One of Google's biggest acquisitions ever, or no, its largest acquisition ever.
Largest ever.
Yeah.
This is their largest acquisition ever. Also an all-cash deal.
Yeah, I know.
$32 billion.
Yeah. Also,
the founders have previously sold another giant company to Microsoft.
Really?
Yeah.
God. Full credit. But look, I think the reason we want to talk about it is not just because of the news story, but I think there's a couple of really interesting investing lessons and trends that are worth talking about. So I think the first one is after a few years where it was off, the M&A window is open
Big
again
time.
in America.
Yes, big time. We saw through the most recent presidency that Lena Khan was head of the Federal Trade Commission and was pretty hot on these sort of acquisitions, or not hot on, but trying to ensure that these large companies don't just go out and acquire everyone. But now I think that she's not in that position anymore, and there's a new presidency, and there's a feeling that this deregulation is going to allow this sort of stuff to happen.
There is a certain ideological wing of Trump's MAGA movement, particularly embodied by J.D. Vance, who really liked Lena Khan. They were like, she was the one Biden administration official they liked because they also agree with a lot of this, like problems with corporate consolidation and problems with antitrust. And it's not just in tech, although like it particularly was focused on tech. Lena Khan's PhD was on Amazon. It was, like she was stopping supermarket mergers and she was stopping everything.
Yeah.
But yeah, it looks like the competing ideological forces in the Trump movement, the J.D. Vance wing, looks like they may have lost to the more like Scott Bessent, Elon Musk, like pro-corporate
big time.
wing.
Yeah.
Anyway, one to watch, but it's also just worth noting that Google, in my mind, are the greatest of all time when it comes to acquiring. So in terms of acquisition, price paid, value created, some of Google's is pretty incredible. So YouTube is a notable one. They bought it for about $1.5 billion.
Yeah, it's a no-brainer.
By an estimate that we found, and this is actually from a few years ago, they've already made $160 billion back from YouTube. Android operating system they bought for just $50 million. It's now obviously the staple in all non-Apple phones, really, or most non-Apple phones. Bought it for $50 million. Estimated they've earned $112 billion back from it. Google Maps, the technology behind Google Maps, they purchased for $70 million. They, by some estimates, have made about 28 to $30 billion back from it. But what is arguably the greatest acquisition of all time, even better than Meta's acquisition of Instagram for $1 billion,
which is up there,
which has returned about $175 billion, is DoubleClick. Not a well-known name, but really like the power behind a lot of Google's ads business.
Yeah.
They acquired it for $3 billion, and by some estimates, it's done more than $180 billion, returned more than $180 billion for Google. So we're not saying that Wiz is going to sit in this category.
Yeah.
I think Google had like a really strong period of
because they've made plenty of others.
Yeah. But full credit to Google.
Full credit,
all roads lead back to Google.
That's right. Well, if you'd like to keep up with all of the news that is making headlines around the world, make sure you subscribe to our daily newsletter. There'll be a link in the feed. There'll be a link in the show description, I should say. We'll send you the most important news headlines straight to your inbox every morning, 6 a.m. There's also a podcast called Headlines by Equity Mates where we turn that email into headlines in sort of less than 5 minutes. So make sure you are subscribed.
All right, well, we'll be back in a sec with a Pimp My Portfolio where Adam Dawes is going to review the portfolio of one Equity Mates community member.
Alrighty, it is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
That's it. We have a segment where we get a community member submit their portfolio so our expert can provide some insights. And today we have in the studio our expert, Adam Dawes. Welcome.
Great to be here, guys. Thank you.
And Equity Mates community member on the line, Mithun. Mithun, how are you?
Yeah, good, guys. Thank you for having me on the pod. Been following you guys for quite some time now, so looking forward to it.
Well, thank you for the support. We appreciate you taking the time today to come on the show and share your portfolio with the community. Ren, take us through it.
Okay, so Mithun's portfolio, I'm going to hazard a guess, is a core and satellite approach. Two big ETFs anchoring the core. We've got VAS, the Vanguard Australia Index ETF, 25% of the portfolio, and IVV, the S&P 500 ETF, also about 25% of the portfolio. Then we've got 8 stocks that make up the other 50%. In order of largest holding to smallest holding, we've got Technology One, Tesla, Washington Soul Parts, CSL, Nvidia, Harvey Norman, Pro Medicus, and Macquarie Group.
Nice.
A spread of sectors and markets and growth rates in those stocks. So, Dawesy, we always like to start with a nickname. Do you have a nickname for this portfolio?
So this one is called the Strong Man portfolio. This is a very good, strong portfolio, and everyone should take listening to what Mithun's got in this one because it's a fantastic one.
Wow. There you go. Okay. So I guess we end the segment there.
I appreciate that, Adam. Cheers for that.
Well, Mithun, with that said, what's been your strategy? Do you have, experience in the field? How have you come to build this portfolio?
Yeah, so I guess for a bit of context, I was influenced by my grandfather who actually used to trade stocks back in the 60s. So he actually introduced me to the likes of Peter Lynch, Munger, Warren Buffett, and taking that on board, I'm largely long-term oriented. I like to look at the thematics. I like to look at the valuation myself, running the DCFs. And I guess, not sure if it's cheating or not, but I do a bit of equity research for the Wall Street Oasis. And then working within the capital markets team at Deloitte, you are exposed to working across the big banks and a lot of the debt side as well. So I guess I have a bit of background in finance. But yeah, again, if you look at my portfolio, it is largely concentrated across financials, healthcare, tech, and consumer discretionary. And that's just largely because I understand the business model a bit more. I understand the industry drivers, the headwinds a bit more. And I do believe that they're largely what I call defensive growth stocks, where you've got the best of cyclicals and you've got the best of defensives. And that's kind of how I've approached stock picking for my personal portfolio, at least.
Nice.
So, Mithun, before we get to Dawesy, I want to ask one question because it would be rare if you took a sample of 1,000 active managers' portfolios. I think you would rarely see Harvey Norman and Tesla showing up in the same portfolio. So, what's the unifying thread that draws those two stocks together?
No, you've hit something on the head right there. So, I guess with Tesla, so that was on my watch list for quite some time now. I got in quite early at 170 once it kind of dipped to the bottom. And I think it's just because investors were quite concerned, obviously, about the global EV market. But in my opinion, I think it's got great fundamentals. It's holding a 50% market share for the most part. And although there's a big growth ceiling, I think getting in quite early sets you at a bit of an advantage. Now, Harvey Norman. So Harvey Norman is pretty much, I got in at pretty good timing, got in quite cheap. And then over the last year and a half, it's seen maybe 25%. And it's a strong dividend stock. And not that I'm an income investor. I thought having that safety there, having that 4%, 5% yield combined with a 2-3% earnings rate positions me quite well just against downsides. It's quite out of the blue there with your big tech stocks, your Nvidias, and then obviously your healthcare companies there as well.
All right, Dawesy. Yeah. Well, over to you. Where do you want to start?
Well, yeah, look, I mean, let's talk the ETFs first because we've always talked about core versus satellite. You guys have been talking about it forever, right? Yes. So it's like, this is absolutely perfect because you've got the American market and you've got the Australian market. So I think that's great. I would try and split that out, maybe do some of Europe. Europe has actually outperformed the US. In the last quarter, it's up 10% versus the US up 2%. So I think, getting some of that European exposure. Is the war going to finish? There's a lot of policy changes at the ground level in Europe, which is starting to bring business back on its feet. So I think that you could definitely look for something like that to sort of bring out that core side of things for you there, Mithun.
Yep.
And then look, Harvey Norman. Look, this portfolio would be perfect if you had JB Hi-Fi in there. I think Harvey Norman is certainly the second best in that space. I see where you mean by defensive, because most of it is a property trust, let's be honest, to a lot of it. And that's what's holding up its value is the actual property that they own versus the franchisee model, which hasn't really worked for Harvey Norman. So I think overall, it's not a bad stock. And if you got in at a good price, you'd be okay to hold it. But certainly the number one leader in the space is JB Hi-Fi. But at $93, I think it looks way too expensive as well. So it's not a bad one there. Certainly the rest of the stocks in there, Technology One, what a cracker. Like, it's just been an absolutely beautiful stock and will continue to sort of keep going. So I'd definitely be holding that. Pro Medicus, I mean, what a beast that is as well. It is just absolutely non-stop. A little bit of weakness the last coming couple of days, but overall, that's a fantastic business. CSL, NVIDIA, I get annoyed with NVIDIA because basically the whole world is now waiting for them to slip up. And it's like the American market, if NVIDIA fails, then everything's going to go down, or the global market is waiting for one stock to fall over. It's really, really annoying. However, they see continued growth going on for a long time, and so certainly data centers will continue to keep going, and then NVIDIA looks really good as well in there. Macquarie Group can't fold as well. And Soul Patts, so Harvey Norman and Soul Patts are probably your both defensive side of things that are paying you a little bit of income, but they're still very, very good businesses as well. So I'd expand out the ETFs. I'd get some more regional ETFs in there, or a world ETF. And I'm talking a lot about small caps to people. We've seen the Magnificent Seven run 50% of their growth over the last year was in the S&P 500 out of 7 companies. That means that there's 490 other 3 companies that need to start lifting. In fact, the small caps need to move there as well. So I'd definitely be putting some global small caps and some Aussie small caps into this portfolio to sort of build out that core.
When you add small cap exposure, do you have a preference? Like, do you want to be picking small caps? Do you want to be finding an active small cap manager, or are you looking at indexes?
No, you need an active. In the small cap, like, you can pick IVV and you can pick all your indexes, not a problem. But in the small cap space, you need to have an active manager in there that really knows how to pick. And basically, an active manager will pick 10 stocks. They'll get 2 right. But those 2 will absolutely outperform, and the other 8 will just fall away. So I don't have time. I've tried to do it myself. And even on where I'm so close to the market, I fail regularly because I just don't have the time to look at it. So an active small cap manager, hands down, globally as well as here in Australia, are really, really important.
Without having to pick your favourite, any names that Mithin can go and do some research on?
Yeah, so I've got to pick names if we've got. Yeah, so VSO, which is the small cap Aussie one, it's just a really good one. DGSM, which is a Dimensional Global Small Cap Fund. It's got 4,500 small caps around the world, so it's a true small cap portfolio. And then you could look at QSML, which is a quality, like Qual, but a quality small cap. So they overlay the same kind of things as, low debt, high return on equity, those kinds of things. So there's a couple in there that you can definitely choose.
Love that.
Nice. Now, Mithin, before we go, Tesla down 40% since its peak in late December 2024. Elon on the ropes at the moment. What are your thoughts?
Well, I guess that's the question we've all been asking, right? I think unlike the other companies in my portfolio, I think with Tesla, I'm keeping it quite close to my chest. Just keeping an eye out, obviously, with each earnings results, because at the end of the day, they are quite concentrated across that EV market. But what I'm really preying on is their energy storage unit. I think it carries better margins. I think they've got a great opportunity to expand beyond those Chinese EV manufacturers that have been taking out their market share. But again, it's like you mentioned, I think investors aren't quite optimistic. There's a lot of trade tensions as well that could potentially impact sales moving forward. But it is something I'll be really keeping an eye on moving forward and potentially reallocating into a different company.
It's been tough. It really has. It's been tough. I think the driverless cars, I think, is really going to be the next wave, and those storage side of things as well. You're right, Mithin. So overall, Tesla, EV sales have fallen around the world. It's not just Tesla. It's globally EV sales have fallen over by 20%. So it gets caught up in that. And if they're 50% of the market share, they probably get a larger pullback in there as well. So just be a little bit careful that the world is against Tesla.
Yes, absolutely.
That's for sure. That's for sure.
Well, as Tesla Bulls would say, it's not the first time that the world's been against Tesla. So we will be watching, and we'll certainly be speaking about it on the podcast. But Mithin, thank you for submitting the portfolio. I think as Dawesy said, there's a lot to like about this. The core, you've obviously know the stocks that you're buying, and you've got a thesis that you can articulate, which I think is so important. Think about global diversification outside of the US and Australia. Think about some smalls, but I think the main takeaway is you're doing a lot right.
Definitely.
No, I really appreciate that, guys. And again, thank you for having me on. Been following you guys for quite some time now, so looking forward to all your future segments. Thanks, Dawesy. Really appreciate it.
Absolutely.
Love it. Thank you so much, Mithan. You have a great day.
You too, guys. Take care. Cheers.
Well, if you would like to submit your portfolio, just like Mithan did, you can head to equitymates.com/contact. All the information will be there. And if you'd like to chat to Adam and the team or any of our other advisors, equitymates.com/advice. Adam is also doing a professional portfolio health check where you can get a personalized investment review of your portfolio aligned with your goals and your risk tolerance. And it'll also include a tailored statement of advice. So it's $750 plus GST. You'll get some professional insight into how you can improve your portfolio. Head to equitymates.com/advice. But Dawesy, thank you so much.
Great to be here. Thank you.
Here's how you can avoid making a $700,000 mistake.
Wow.
Yeah.
$700,000
And
mistake.
it's easier than you think.
Well, that is good.
Yeah.
This segment we want to title Reminder, Reinvest Your Dividends, because we've crunched the numbers, we've done some maths, and as Bryce said, it is a $700,000 mistake based on our numbers. I think our very reasonable numbers if you're not. So what we've done is taken the Australian All Ordinaries Index, which tracks the 500 biggest companies in Australia. And we've looked at two indexes. We've looked at the normal index, which just takes the stock market return each year. That's how it moves. And then we've looked at the total return index, which is a variation that assumes you take your dividends and you reinvest them. So we've looked at taking your dividends and going on a shopping spree, taking your dividends and reinvesting them.
Yes.
And then we've said, what would have happened if over the last 40 years, we'd done $200 a month in either index?
Yeah.
And we've looked at the actual returns by year for both index, rather than just the averages over that time. And here are the numbers. $200 a month in the Australian All Ordinaries Index.
Which is the top 500.
Yeah, and that, so this
In
doesn't
Australia.
include the dividends.
Yeah.
You would have had $305,000. So not bad. What, $200 a month is $2,400 a year over 40 years. So you're investing about $80,000
Yeah.
and you've got over $300,000 back.
Yeah.
4x to your money, not bad.
Can't complain.
If you took that same $200 and invested it in the All Ordinaries Total Return Index, $1.03 million.
Wow.
Yeah. And how that works out, so over 40 years, the compound annual growth rate for the index itself is 5.95%, but the compound annual growth rate for the index with dividends reinvested, 10.36%.
That's why Aussies love dividends.
Yeah, that's why you've got to think about what you're doing with your dividends.
Yes, yeah. Now I can hear people sitting there, may have just started their investing journey. How do I do this? How do I make sure? It is not done through your broker. It is important that.
Well, there's two ways.
Two ways, sure.
Yeah.
If you want to actually reinvest the dividends that your company pays back into the same company or back into your ETF, it needs to be done through your registry. The second thing to remember is if you are with a custodian broker, you can't actually do it.
Well, yeah, I think this is getting confusing. So for me, there's an automated way and then a non-automated way to do it. So what you're talking about is the automated way, where there are official dividend reinvestment plans where you sign up for the dividend reinvestment plan with
Through your registry.
the share registry, which is different to your broker. And then that you won't see the dividends in your bank account, that you will get nominally paid them, but the registry will hold them. And then when you have enough money to buy a full unit of the share, they will buy those shares.
And that can only be done if you're with a CHESS broker.
Yes.
Yeah.
Which makes sense if you're an Australian investor, and if you're an overseas investor, don't worry about it. So that's one way. That's an official dividend reinvestment plan. The other way is just when you get paid your dividends, reinvesting them.
Yes.
Yeah, and so like that's what I do. I don't use official dividend reinvestment plans, but what I do is when the money hits my brokerage account, I don't withdraw it and I reinvest it. And what I try and do is, because I have separate separate brokerages for my core portfolio and my satellite portfolio. So any dividends that come through for my core portfolio get reinvested into my core portfolio.
Yeah.
You can do it that way as well. Like that still gets you reinvesting your dividends. That still gets you to that, to that 1 million number, not that 300,000 number. All we want to say is if you do it automatically with a dividend reinvestment plan, or you do it manually by actually just getting paid the dividends and reinvesting them, think about your dividends and what you're doing with them, because it could be, as Bryce said, a $700,000 mistake.
Big time. So that brings us to the end of today's episode. We love hearing from you. If you have a question for us, if you have a stock that you'd like us to look at, if you want to contribute to Pimp My Portfolio, head to equitymates.com/contact. All the information will be there for you to get in touch with us. Or you can leave us a voicemail for a question on the show. We do really love hearing from you and getting you on the show. If you also take a lot of value out of what we do, we would appreciate if you could spend 60 seconds leaving us a rating and a review in your podcast app now, or like the video, subscribe wherever you are watching us as well. But Ran, that brings us to the end of today's episode. Huge one tomorrow with Chris Joy. So make sure you listen to that, but we'll pick it up on Thursday.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.